You know, we talk a lot about tax-free investments and other options that are out there, and most of the time when we are talking about tax-free, usually it's Roth IRAs or Roth 401ks, but you know, a lot of times people will use municipal bonds and think that, well, I'm in the clear, this is a tax-free investment. Matt, can you spend a little time talking about why that might be a...
You know, I'm glad that we're talking about this here today, Dustin, because there's actually some advertisements that are going on right now. If you watch some of the business channels, business news channels, where they're talking about the fact that municipal bonds will be tax-free. And I think in some cases they're going to be tax-free, but I think this is one area where it's a strategy or an investment that's kind of masquerading as a tax-free instrument, because in order for something to truly be tax-free, you don't want to pay any federal income taxes.
Right.
You don't want to have to pay any state income taxes. You don't want to have any capital gains taxes. And then the big issue is you don't want the income that the instrument is generating to hurt you when it comes to your Social Security, because with Social Security, you're limited to how much provisional income you can have before you can start having some tax consequences of that. So I think if we look at it, you know, municipal bonds are generally federally tax-free, so that can be good. But are they tax-free? Are they always tax-free from a state income tax?
Absolutely not.
Yeah, well, absolutely not, but I guess the real answer is maybe, right? And what I mean by that is I'm a resident of the state of Kentucky. So I live in the state of Kentucky. If I buy a municipal bond in the state of Kentucky, the state likes that. They're not going to tax me on the interest, right? But what if I want to go buy a municipal bond from Iowa? Because is the state of Kentucky going to be real excited about that?
No.
More than likely not, right? So I'm going to have to pay some tax there. So if I have to pay state income tax on it, it's not truly tax-free. The other issue that I think a lot of times individuals just don't understand is a lot of times we're always told, you know, you don't want to put all your eggs into one basket. So if you don't want to own just one municipal bond, maybe you would go buy a bond fund or a bond ETF or something like that. So what can happen there is if you buy into a municipal bond fund, well, you're going to generate some interest along the way that may or may not be taxable, depending on what state those bonds are in. But what if you sell that fund in the future for a profit? So in other words, you bought the fund at $10 a share and you sold it 4 years later at $11 or $12 a share, you're going to have to pay long-term capital gains tax on that growth. So that's another area where municipal bonds aren't truly tax-free. And then I think probably the biggest issue really facing a lot of retirees and pre-retirees is the fact that whatever interest you're generating on your municipal bonds counts towards your provisional income when it comes to Social Security, and determining if you're going to have to pay taxes on 50% of your Social Security or as much as 85% of your Social Security. So even if you have a municipal bond where it's an individual bond, it's not a fund, so you don't have to worry about capital gains, and let's say you do own the bond in the state that you live, so there's no state income tax, and again, there's no federal income tax, the fact that you're generating income from that bond at all can count against your provisional income for Social Security, and you can end up having to pay tax on that. So it's an instrument that it can be helpful. It's not always a bad thing to have, but individuals need to understand that municipal bonds aren't truly always tax-free. They might be tax a little more efficient than other options, but a lot of times not necessarily tax-free.
You know, Jordan, Matt just said it's not truly tax-free. What is truly tax-free? What does that actually mean?
Well, like you said, it has to be federally tax-free, it has to be state tax-free, all those other variables that come into the equation. It has to be 100% tax-free. So to answer your question, Dustin, Roth IRAs, Roth 401ks, certain forms of life insurance. But those types of strategies, nothing is taxable. The only portion that's taxed is the seed up front, as opposed to the harvest in the future, which puts us in a much better position because, like you said, if we do sell something a couple years down the road, we're not paying taxes in a tax-free account like a Roth, but in a municipal bond fund or ETF, we're paying taxes on that.
Yeah, and the real issue that individuals are faced with is, let's say that you're over age 70 and a half, and you're now required to take required minimum distributions, RMDs, from your 401ks, IRAs, things of that nature. So a lot of times if you take the RMD, that's provisional income. Maybe you've got some money in CDs or something like that at the bank or money market account, something of that nature. Well, whatever interest that generates is going to count against provisional income. Now, like Jordan just mentioned, maybe you've got a Roth IRA that you're taking some withdrawals from. There's no provisional income there.
All, right?
But then if you have municipal bonds where, again, you think that it's a tax-free instrument, whatever you generate in interest on those bonds or yield that does count against your provisional income. So let's say you have $500,000 in your municipal bonds, and let's say that you're lucky enough that you're maybe getting 4% interest. Well, that's going to be $20,000 worth of provisional income. So between that and your RMDs, you're probably putting yourself into a scenario where at least 50% of your Social Security is getting taxed. In most cases, probably at that point, with this type of scenario, would be 85%. And what ends up happening is that can kind of be a snowball, gaining momentum down the hill, because if your Social Security ends up having you end up having to pay taxes on your Social Security income, where's that money going to come from? So a lot of times what you've got to do is maybe go back to your 401k or your IRA, take an even larger withdrawal,
Pay the taxes
to
on
pay
that.
the taxes, and then the following year that's going to be taxed.
Yeah.
So what ends up happening is it's kind of a spiraling effect, snowball rolling down the hill, whatever you want to call it, to where the fact that individuals thought that they had these really tax efficient instruments, it wasn't truly tax free, and it can cause a lot of different problems.
Yeah. So if you have any questions about your portfolio and whether or not it's set up as efficiently tax-wise as possible, feel free to check us out on our website or give us a call at the office. Because there's a lot of misunderstandings, I think, that go on with variable annuities. One, that they're safe, and two, that the fees are low. And I just wanted to spend some time talking about it. Matt, I know you and I talk a lot about annuities and the different types that are out there, and one annuity that you and I both feel exactly the same way on it is going to be the variable annuities. And I just wanted to spend a little bit of time talking today about why that is, because there's a lot of misunderstandings, I think, that go on with variable annuities. One, that they're safe, and two, that the fees are low. And I just wanted to spend some time talking about
Yeah, it's kind of like we mention all the time on the show that not all annuities are created equal. Some annuities are really good, and some annuities aren't so good. Like you just mentioned, I think the majority of the time we'll recommend individuals typically, there's some exceptions to it, but typically to steer clear of the variable annuity. I think this is going to be a great exercise for all of our viewers, because a lot of times individuals that have these types of accounts, they don't really realize how enormous the fees and expenses can be on these types of accounts. So they might not like what we're going to share, but they need to know.
They need to know. Yeah, and we've done probably thousands of reports now up to this point on variable annuities that are out there, and it's just a law of averages. And what I'm going to use here is I'm just going to use kind of an average number. It could be a little higher. It's usually not going to be much lower than this, though.
I think that's fair.
So there's several different fees and expenses that you're gonna have on a variable annuity, and it's not something they're going to put on your statement. They're not going to show, okay, here's the deduction. There might be the annual fee that's $50 a year or $35 a year, but that's not.
Yeah, that's nowhere near the whole story.
Nowhere near. So one fee that I would say almost every variable annuity has that's out there is something called a mortality and expense fee. And to me, this is a fee that it's unbelievable that they get away with charging it, because it's your money. So let's say I put $100,000 into an account, and that account falls to $95,000, and then something happened, and God forbid you were to pass away. Well, this mortality and expense fee is so that when you die, your family gets your money.
Your original amount of money.
Yeah,
right?
your original amount of money. So what they charge there, it's usually 1.35% is the most common number, but I'm going to use 1% for this example. So what they're going to do is every year they're going to take that fee out in order to pay a life insurance for you.
Yeah, absolutely. There's another way of looking at that. It's just a cost of life insurance, right? And I think this is probably some of the most expensive life insurance you could ever own, because think about what you just said. If the account falls in value, the family or beneficiary, whoever it is, will get the original amount of money you deposited back.
Right.
But what happens if the account actually goes up in value?
Then you're just basically throwing
You're just getting, the family would just get your money.
Right.
There's no life insurance, but they're going to charge you the 1% anyway.
Right.
Okay.
So the next fee that we're going to see is inside variable annuities, they're going to have something called sub-accounts. And sub-account basically is just a collection of mutual funds. So, I mean, we've talked a lot about mutual fund fees, and they're going to range 1 to 4% on their own. But for this example, let's use 1% again. So 1% a year is kind of a conservative estimate for mutual funds that are inside of the sub-account.
It's not going to be any lower than that.
No, it's not. The next fee is something where a lot of times you'll see an advisor recommend some type of income plan or some type of death benefit or something like that, and that's going to be what's called a rider fee. Again, we're going to see typically a little over 1%, but for this example, let's just use 1% again. The next fee that we see is something called distribution cost. Distribution cost is basically so that you're paying for them to mail you your statements, any marketing materials, anything you see.
Anything you should get.
Anything you should get,
ordinarily.
right,
Yeah.
right.
Yeah.
So there's another 1% that you're going to pay every year, roughly, coming out of that account. So let's just total these fees up, and again, we're being very conservative here.
Right.
Well, we're going to have 4% per year on this account. Now, let's look at this, and let's say we have let's say it's a $500,000 account. Well, that means that you're going to pay $20,000 per year
Right.
on that $500,000
Every
account.
single year.
Every single year. And it doesn't matter if the account's up, if it's down,
Yeah.
you're going to have to pay that 4% per year. Now, I would say majority of the time when people do have a variable annuity, they'll think that they're locked in that variable annuity.
Or stuck.
Or stuck,
Right,
yeah. But I mean, out of 10 times, how many times would you say, roughly?
So here's the thing: when you look at a variable annuity and you find out the fees are rarely this low, they're usually much higher than
Yeah.
that. Individuals say, well, I signed up for a certain number of years. If I do anything different, I might have a surrender charge or a penalty, things like that. But probably about 9 times out of 10,
Yeah.
there are things that can be done to get around those penalties. You're not usually stuck paying these high fees and expenses. You can move the money someplace else or change the variable annuity to reduce the cost. You're not just stuck and not forced to continue to pay these fees all into the future.
Yeah, so not every time, but 9 times out of 10, that's a pretty strong percentage as to ways to reduce or maybe even eliminate those fees altogether. And a lot of times we'll see that the surrender fee is what they'll call it to get out, could be 4%. So you're either 4% to stay in or 4% to get out. So
Yeah, that's an important point. You got to look at it like that sometimes. Let's say it is 4%. Well, that's going to be, this is an annual fee they're going to charge every single year, but if you pay the 4% penalty to get out of it, that's just a one-time cost.
Right.
Which nobody gets real excited about it, but they're going to get you one way or the other.
Yeah.
You might as well kind of stop the cost
shut it off. Yeah.
and move to something a little more efficient. And even sometimes there are some strategies where you can get the fee that it costs you to get out of it reimbursed.
Yeah.
Not always, but sometimes.
That's right. So if you have a variable annuity in your portfolio, give us a call and let's get our arms around exactly what you're paying fees and expenses wise and see if there's anything that we can do to help you at least reduce or maybe even eliminate them altogether. Now you've built up this nice nest egg, and let's say that you have $500,000 into this nest egg. Well, if you think about it, you haven't paid any taxes on this money yet. So how much of that money is really yours at this point? On this segment, I want to talk about who really owns your 401k or your IRA account. And what I mean by that is you spend your whole life putting money away, and whether it's through your employer or if you're just contributing into an IRA, and now you've built up this nice nest egg. And let's say that you have $500,000 into this nest egg. Well, if you think about it, you haven't paid any taxes on this money yet. So how much of that money is really yours at this point? Well, let's just say for this example's sake that if you were to withdraw that money, you would get to keep roughly 70% of the portfolio. So that means, well, let's first think of it as if this is a business. Let's say you have a business that's worth $500,000 and you have a silent partner that owns 30% of that business. Well, let's say that we let that business grow and grow and grow, and we come back 10, 12 years from now, and that business that was worth $500,000 10 or 12 years ago, you've now grown it to $2 million. So you've worked your hind end off, and you have built this business up to now it's worth $2 million. Well, guess what? Your silent partner no longer owns 30% of that business. The more you make and the more you have, the more your silent partner is going to earn. Not only that, but they can adjust their percentage at any time they would like. So now, let's think about this. If you have a silent partner in a business and they aren't doing anything, they're not doing any work, they let you have a little bit of money to start with, but they didn't put any hard work into it. Does it make sense to maintain that relationship, maintain that partnership, and then pay them a larger percentage of the business, or would it make sense to buy them out when it was only worth $500,000 and they own 30%? Well, of course it would be in your best interest to go ahead and buy them out, and when it's worth $500,000, that way when it's worth $2 million, you get to keep all of it. Well, now, instead of a business, this is your 401k. You have a silent partner, which is the government, and they're going to get to adjust their percentage anytime that they would like to. Not only can they adjust their percentage, but if you didn't need to take the money out, let's say for this example, what they're going to do is they're going to make you start taking the money out at some point. So you can let the money grow and not take anything out, not pay any taxes until you're 70 and a half years old. When you're 70 and a half, now the government says, okay, we've let you have all this time, now it's time to start taking this money out. So what they do is they say, okay, at 70 and a half, we want you to take a little less than 4% out, and then you got to pay us the taxes on it. And then let's say that you didn't need it that year. Well, they don't care. You have to take that money out. Whether you need it or not, it's going to come out of the account. If you don't take it out, the government is going to penalize you 50% of that withdrawal. So let's look at an example. And let's say that you needed to take a withdrawal or an RMD, required minimum distribution, of $50,000. Let's say that was your minimum that you had to take out for the year. Well, if you didn't want that money and you said, you know what, I'm not going to take the withdrawal this year. Well, the government is now going to penalize you 50% of that $50,000. So they would penalize you $25,000. So not only would you have to take the withdrawal, now you would only get to keep half of it, and you got to pay all the taxes on that. So it ends up being, after taxes, penalty, and interest, right around probably 70% penalty because you didn't want to take the withdrawal. So going back to the 401k and having your silent partner, they're going to make you buy them out at some point. So when would be the best time to buy them out? Of course, at the beginning. But we see all the time, a lot of people will put it off until it's a little too late. Now they're stuck paying too much in taxes. So if you have any questions about how to become more tax efficient, the sooner you can do it, the better. Give us a call at the office and we'll be happy to help you see what the most tax efficient method of investing would be.
Today I want to talk about something really interesting with you all, and that's what's known as an exchange-traded fund, right? An exchange-traded fund. If you've heard about these, you've probably heard of them as what's known as an ETF. Welcome to this week's segment of Strategic Wealth University. Today I want to talk about something really interesting with you all, and that's what's known as an exchange-traded fund, right? An exchange-traded fund. If you've heard about these, you've probably heard of them as what's known as an ETF. So simply put, the best way I can describe it is, if we think about it, if we look over here, we have stocks, and stocks are great because we have the diversification, or rather we have the ability to buy and sell a stock throughout the trading day. And with the stock, the only cost is going to be the buy or the sell. But as we've seen with stocks, one of the possible downturns is, as that stock rises and falls, we're going to rise and fall with it. Now, if we look over here, we have mutual funds, and mutual funds are great because they have diversification. You know, we can invest in a broad basket of investments, like a group of stocks, a group of bonds, maybe even a group of gold investments or something along the lines of that. But one of the challenges with mutual funds is that oftentimes they're going to have really high fees. Typically with mutual funds, we can see fees ranging anywhere between 1% to maybe 3% per year. Sometimes it can be higher, sometimes it can be less, but oftentimes the fees can be really high. As well as the fees being really high, a lot of times with mutual funds, a lot of people don't know this, you can only buy and sell a mutual fund at 4 o'clock during the trading day. Right, you can only buy and sell a mutual fund at 4 o'clock during the trading day. So as we've seen something like 2008, or we had that Black Monday a number of years ago where the market just substantially lost. A lot can happen through the course of a trading day. So basically what an ETF is it basically takes the best of both worlds. We get the low-cost structure of a stock, the ability to buy and sell a stock throughout the trading day, and we have the diversification of a mutual fund. And an ETF basically takes the best of both of those worlds. Now, with exchange-traded funds, they are something that we will use in our managed money portfolios. They're gaining a lot of traction and popularity. I think it's a great low-cost alternative to mutual funds. With our industry rapidly changing and with the consumer's goals oftentimes changing, I think ETFs are going to be a much more used strategy as we move into the future. Now with an ETF, you can get one that pretty much tracks anything you can imagine, anything from stocks to bonds to commodities to precious metals to real estate to the price of 3D printing or vertical farming, but pretty much anything and everything that you can think about. So when it comes to investing with an ETF, there's risk associated with it. And you want to make sure that you have just as much risk in your portfolio that you're comfortable with. I know we oftentimes will talk about this, where you want to make sure that your goals and your objectives in your portfolio, they really line up with your actual portfolio, because a lot of times there's that disconnect. So a great way to use some tools, and something that we have as a firm that we use a lot of times to help folks get a better idea as to if their risk matches the reward, we use what's called a stress test. Right, we use what's called a stress test, and that's a really cool piece of software. What that does is it shows us kind of in black and white in a real simple way if the risk matches the reward. And then what we can do from there is we can pinpoint and figure out how much risk would need to be added, how much risk would need to be cut. And like I said, maybe 7, 8, 9 times out of 10, folks' portfolios have way more risk in them than they're actually comfortable with. So if you'd like to learn a little bit more about ETFs, we've got some great resources on the website. You can feel free to call the office, and we can give you some really cool, simple one-page summaries that we did to teach you a little bit more about ETFs. And as always, if you have any questions, if you need help with anything, just give us a call or feel free to check us out on the website. Thank you.